Some of you have never seen a real recession, and it shows. How's it going, everybody? Welcome back to the channel. My name is Jay, and the lights behind me are red because the stock market is crashing. Stock up on canned goods and toilet paper. Get ready for the worst. The sky is falling. Stocks are dropping.
Watch the audio levels.
What's that?
No, dude, it's cool. The S&P's even for the week.
Oh, the S&P is even on the week?
Yeah, actually, it says right here, we're up for the month.
And we're up this month? Yeah?
60% on the year. But seriously, watch the audio levels, man.
Huh. I wonder where I could have gotten that idea. But seriously, we should all know the stock market doesn't go up in a straight line. There's gonna be ups, there's gonna be downs, there's gonna be periods where it goes sideways. And if you've been watching a lot of other finance YouTube or CNBC, you may have gotten the impression lately that stocks were falling through the floor and everyone was losing all their money. But that's simply not the case. You see, the market is doing just fine. As I mentioned a little earlier, the S&P is even for this week, it's up for this month, it's up for the past 3 months, and it is well up for the year. What is crashing are the hot, trendy tech stocks that everyone has been talking about and piling into over the past year. So yeah, if you're someone who doesn't take my advice and have a diversified, well-balanced portfolio that will do well in any kind of market situation, and you've just been piling money into trendy stocks that are talked about on YouTube and social media and TV, then you're probably getting hurt right now. But the rest of us, we're doing just fine. And yes, there have been some significant down days in the market over the past month or so. But like I said before, the market doesn't go up in a straight line. There's up days, there's down days. So every time the market ends in the red isn't cause to go screaming that the market is crashing, stocks are falling, I can't believe what's happening. Especially when the drops aren't really that significant to begin with. We as investors have to be prepared for any kind of market situation. On average, the S&P 500 will have a decline of 5% or greater once every 7 months. It'll have a decline of 10% or greater about once every 2 years. And it'll have a decline of 20% or greater about once every 7 years. Now, we haven't seen anything close to a 5% pullback yet this year. And even if we did, it's not a big deal. Since 1945, the S&P 500 has dropped between 5 and 10% 80 times. Out of those 80 times it's dropped between 5 and 10%, the average length of that decline is about 1 month. And the average time for the S&P 500 to recover from that 5 to 10% drop is also 1 month. Now, a 5 to 10% drop is a significant drop, but as we can see over the history of the S&P 500, those kind of drops happen quickly and they recover quickly. So, next time it happens, sometime within the next 7 months probably, don't freak out. Use it as an opportunity to add to your positions, whether it be your index funds or some stocks you really believe in, and just stay the course. It'll get better. Now, in that same time period, since 1945, the S&P 500 is dropped between 10 and 20%, 29 different times. Now that is a big drop, but still, the average length of those 10 to 20% drops is only 4 months. And the average time to recover from those drops is also 4 months. Now, where we might want to start talking about the market is crashing and everything is falling is when the stock market drops 20 to 40%, or even greater than 40%. It's dropped between 20 and 40% 8 different times, and dropped more than 40% 3 times. Now, these are real recessions that hurt. They hurt your investments, people are losing their jobs, and the general mood in the country as a whole is probably pretty bad. But still, the average length of the decline of one of these 20 to 40% drops is about a year, and the average time for the stock market to totally recover from that is 15 months. So yeah, while you're in it, a year and 15 months feels like an eternity, but over the course of your investing career, that's really nothing. Even if you got a late start to your investing life, you're still going to be investing for probably 20, 25 years at a minimum. So one of these year-long recessions where the market drops 20 to 40% and stays there for about a year makes up a blip on the radar of your overall investing life. Now, those greater than 40% drops, luckily there's only been 3 of them since 1945. They last a little bit longer, almost 2 years, and the time to recover from those is much longer at 58 months. So yeah, those are things we really got to worry about. But luckily, something like that has only happened 3 times in the last 80 years. So I'm not going to sit here and lose sleep that something like that is going to happen anytime soon. So what's the takeaway here? The takeaway is there's a reason I talk about boring investing, like keeping the most of the money you have invested in boring old index funds, not getting too caught up in the latest hot stocks, or throwing too much money in cryptocurrency and things like that. It's about tuning out the noise and having a plan to deal with the volatility. Because the volatility will come. You're going to see those 5% drops at least once every 7 months. So it's about being prepared for when they happen and capitalizing on them when they do. Use those 5% drops as buying opportunities. If the market does drop further or faster, be prepared. Don't try to time the market, just continually invest, stick to your plan, stay the course, and don't panic because the sky isn't falling. This time isn't different.
Do you want to do the hit the like button thing?
Hit that thumbs up button below if you're with me in being a calm, rational investor. Check out these 2 videos over here if you want to learn more about how I invest and how I think you can become a better investor. And remember, if you have the right time frame, stocks only go up.